Welcome to another episode of Equity Street, where we provide the roadmap to property wealth. We're answering the questions of real estate investors across the country, and of course, I am joined by one of Australia's leading property experts, Matthew Bauer, to answer your questions. So let's get straight on into it. Now, this one comes from Joe and James, and they've said, when talking capital growth, what should I be looking for in relation to an annual growth rate?
Yeah, really good question, and I guess could be forgiven for thinking that the last 12 months is the norm in terms of the healthy double-digit capital growth, whether it's been 20 or 30% in Sydney or markets similar to that, and even some of the regional centres. So I think if we look backwards and understand that the long term, when I say long term, perhaps 40 years plus, the combined capital cities averaged out growth rate is typically between 7 and 8.5% capital growth, somewhere in that range. And really what you need to be looking for is saying, okay, cool, as long as my property or my portfolio is consistently growing over the long term. So yes, there'll be periods where you'll be getting that healthy double-digit capital growth, and that's fantastic. But also, irrespective of what all the broader markets are doing, is ensuring you're still able to get that consistent growth across your entire portfolio. And that'll come down to your own personal circumstances as to how you achieve that, what property types, in what locations as well, and things to be mindful of or look out for as those, overheated hot spots that are being driven by, a short-term proposition.